So, Andrew, just help us look at this historic deal first. It is at a steep discount to Credit Suisse's closing price last Friday. We're also likely to see bondholders of Credit Suisse wiped out according to the terms of this deal. To what extent do you think this is going to help prevent the rout or stem the fallout further in Credit Suisse and the banking sector?
Well, there are two aspects here. One is how quickly this, as you say, stem. In all probability, it will. What absolutely horrified me and shocked me were the terms, and that is looking long term and also what's happening in the States. Apparently, you can take all the risks you want in a bank, and then somebody's going to rescue you out. In the case of SVB, okay, the Silicon Valley Bank, the insurance that only goes up to $250,000 was simply thrown out of the window, and the government said, don't worry, we will insure all your deposits. In the case of the UBS, the government steps in and simply disfranchises, I don't want to use the word steal, wipes out the money, 17 billion francs, out of the bondholders. This is absolutely amazing. In other words, I'm much more concerned and a little bit staggered, okay, by the coldness and the harshness of the deal, rather than whether there's going to be enough liquidity. And also, please, don't let anybody tell you that if central banks, okay, help to bail out banks, the taxpayers don't pay for it. They do. The majority of the assets of a central bank is government bonds. Okay, so if the assets of a bank increases by giving loans out to banks, simultaneously, all of it is backed by government bonds in one way or another, and government bonds are backed by the taxpayers. The poor taxpayers will pay for it, and in this particular case, it's going to be the taxpayers and, in inverted commas, the bondholders.
Yeah, it sounds like it's a bailout, even though the Swiss finance minister is insisting that it's not. You talk about the impact on these taxpayers. What are the ramifications going to look like? Is it going to be something beyond the financial stability? Are we going to see economic fallout from this for the Swiss banking sector and perhaps the wider European banking sector?
I don't think so, for the very simple reason that the Swiss central banks, the Swiss National Bank and the Swiss government have said, here is a checkbook, you simply put the one and we'll add the zeros. Of course, that makes me feel completely safe if I happen to be having deals with Credit Suisse, except, of course, if I was a bondholder. If I'm a shareholder, I'll be delighted. The shareholders are affected. Oh, yeah, they're going to lose money, but the bondholders will lose all their money. So the ramifications as far as the Swiss banking system is concerned, and to some extent the global banking system, are good. Okay, you are asking me what are the ramifications. They are benign, they are nice, to the extent that we threw the rule book completely out of the window, both in Switzerland, my God, and also in the United States. You mishandle a bank, you run the bank to the ground, don't worry, the government will save you. Great.
Okay. Andrew, when we look at the situation in the US, regulators there are also looking for a way out for SVB. Signature Bank also potentially has a suitor here. What do you think the banking consolidation, these mergers, these takeovers are going to mean for shareholders overall?
You know, I could be sarcastic and I will tell you, let's put the clock back in the year 2008, okay, where there were a great deal of major consolidation, okay, to the extent, for example, Merrill Lynch was instantly bought, okay, there was a lot of individual smaller banks that they were bought. So there was a consolidation of the banking system. All right, 2008, fast forward to 23, and what's happening? The same thing all over again. So consolidation clearly made absolutely no difference. Now, it's unfair to include Switzerland into that, okay? But I continue to say this is good news for the financial system, and it is terrible news of the way in which the financial system will carry on behaving, because it clearly doesn't matter. I mean, these are two separate things. Now, what's going to happen in 10 years' time? I have no idea. I cannot possibly predict. But will bondholders be much more careful? I imagine so. Will shareholders be less careful? Well, they cannot be less careful than they are now because they're being bailed out.
Okay.
And remember, this is not only in Switzerland. Okay, if Switzerland does that, you can imagine what other, let's say, less clearly and cleanly run financial systems may do it. The United States is already doing it. Okay,
right.
Doesn't
Andrew,
matter.
sorry,
You were insured for $250,000.
Sorry to cut you off there, Andrew. Just one quick question I wanted to ask you before we have to let you go. Will this matter for the Fed this week at its rate-setting meeting? Are we seeing the end of the tightening cycle?
I think not. Okay, I think that the Fed will go, perhaps might not go with the 50, but it could easily go with the 25, saying that the banking crisis has absolutely nothing to do with higher interest rates directed towards inflation. These banks had severe problems, which is not quite true for the SEV, but never mind. I think the Fed will increase by 25 because it will then have very big difficulties in going back and saying, well, now we stopped temporarily, but we're going to start again.
Okay, Andrew. Thank you so much for sharing your insights with us. Andrew Freris, CEO at Ecognosis Advisory.